Welcome to the Ironworth Trading Show. I'm your host, Coach Price. This is not financial advice. This is for educational purposes only. All right. So before we get into tonight's masterclass, I need to teach y'all something first. Because if you walk into investing, right? If you walk into the investing conversation without understanding this simple concept right here, you're going to basically make emotional decisions with your money and not even know why you're doing it. So stay right here. All right, hit the follow button if you're new here. Don't scroll. All I need is about 10-20 minutes before we get into the main content that I really want to bring to you. But what I'm about to show you on this screen is one of the most important things that I can teach inside of Ironworth Trading. This is the foundation, ladies and gentlemen, of every trade I take. And honestly, it applies to investing too. So we'll get into that too in a minute. But yeah, the concept is called risk to reward ratio. And most people who lose money in the market, they have never sat down and actually understood what this means. So everybody do me a favor and share the live out to someone who needs to learn something, something that can help them trade better. Let me make sure I share the live out too while I'm telling y'all to share it. I ain't shared it out yet. 1 second. Let me get it to a couple of my people. How y'all doing tonight? That's better yet. How y'all doing this month, this week? Come on now, let me know how y'all trading journey, how y'all coming along in y'all trading journey. How y'all doing? Stacking gems, says K Murray. Anybody else out there stacking gems like K Murray? What's up? How y'all doing tonight? Small wins so far, but minimal losses. That's what I like to see. That's what I like to see. That's all that matters. You keep that up, you just need to maximize your gains now, right? So you as long as you got the small losses, now you need to maximize your gains. And I'm gonna show you. We're finna talk about that real quick. All right, we're gonna talk about that. Now I want y'all to look at what I'm showing y'all on the screen right now. Right, 1 to 2 always, says Aussie and King. I'm more of a 1 to 3 man myself, but we finna break it down. So I want y'all to look at these pictures, right? We're going to talk about the risk to reward ratio. If you've ever been confused about what a risk to reward ratio is or what it means, I'm going to break this down in the simplest way possible for y'all so that there's no confusion, okay? All I need y'all to do is drop a W in the chat. If you're new here, hit that follow button. Y'all see that plus sign? Just tap that follow button. That's all you got to do. That's the price of admission tonight. All right. So when I say risk to reward ratio, ladies and gentlemen, I mean this. For every dollar I am willing to lose on a trade, how many dollars am I trying to make? Again, when I say risk to reward ratio, for every dollar I'm willing to lose on a trade, how many dollars am I trying to make? That's it, y'all. That's it in the nutshell. We're not going to make this more complicated than it has to be. That's the whole concept right there. So if I risk $1 to make $1, that is a 1-to-1 ratio. If I risk $1 to make $2, that is a 1-to-2. Y'all get it? So if I risk $1 to make $3, that is a 1-to-3. Now, this is where it gets important now. Pay attention. This is the part a lot of beginners, they completely miss this, but y'all not going to miss it because y'all locked in. Your risk to reward ratio directly determines how often you need to win just to be profitable. This shit is math, y'all. I was trying my best not to curse, and there go that shit word. I got to do better. But listen, hear me out. This is math. It's probability. It's not predictability. You don't need a damn crystal ball. Since I went ahead and cussed, we just going to go ahead and pop the top off this month. We lit. It's lit. Right? Basically, with that one, if I risk $1 to make $3, that's a 1-to-3. Okay. So let me say that again. Your risk to reward ratio tells you the minimum win rate that you need to lose money. And that number is gonna surprise you. I'm telling you. That number is gonna surprise you. We finna get to the bottom of it. So look at the first row on this screen, y'all. Look at the first row. There it says risk reward ratio 1-to-1. Right? Win rate required 51%. Out of 100 trades, you need to win 51 of them. You can only lose 49 trades out of 100 with that type of a risk to reward ratio. You understand what I'm saying? You are risking the same amount that you are trying to make. You risking $1 to make $1. All right. Your entry might be here. The stop loss is right below. Your target is the same distance above your entry as your stop loss is below. Right now, at 1-to-1, at a 1-to-1 risk to reward ratio, what win rate do you need to be profitable? 51%. Out of 100 trades, you got to win 51 of them and lose 49 just for you to come out ahead. Now, I know that sounds easy. I know a lot of y'all think that shit sound easy, right? But in reality, when you trade at a 1-to-1, your losses is gonna feel exactly as painful as your wins feel good. You're gonna feel happy as hell when you win money, but you know the losses is gonna hurt you too, just as much as the wins felt good. There is no psychological cushion trading a 1-to-1 risk to reward ratio. A lot of y'all don't pay no attention to your risk to reward ratio, but I need that to stop tonight. If you are still confused, type still confused in the chat so I can make sure we simplify it even more for you. But if you got it, drop a W in the chat. And I already know you got it. Life is too short. I already know you got it, Aussie. K Mary, I'm pretty sure you got it too. But if anybody's still confused about risk to reward ratio, come on, talk to me. Let me know. If not, I'm about to move forward. All right. I'm not confused, but you on point. Okay, Mr. Nice Guy, for sure. So every losing trade hits just as hard as the winning trade helps when you using that 1-to-1. A lot of them, most traders that do that 1-to-1 shit, they gonna end up breaking even at best. All right, they gonna break even at best, and at the worst, they gonna break negative. Right? They emotions then took over and they start cutting their winners short. And they let their losers run. But anyways, a 1-to-1 ratio is not where you want to operate, ladies and gentlemen. That's not where you want to be long term. It's just too tight. It don't give you no room for error, right? Now we're gonna look at the second row, the 1-to-2. Who said they do? Aussie said he used the 1-to-2. All right, so for every dollar I risk, I'm targeting $2 back, right? I get in here and my stop loss. Let's just say my entry's there, my stop loss right below, but now my profit target is twice the distance of my stop loss. Now, what win rate do I need at a 1-to-2 risk to reward ratio? When you doing the 1-to-2, you only need a 34% win rate for you to walk away on top. 34% out of 100 trades, I only need to win 34 of them, and I'm profitable. I want y'all to think about what that means, ladies and gentlemen. I could be wrong 66 times out of 100 trades. Okay, that's 2/3 of the time and still make money. That is the power of a good risk to reward ratio. It completely changes the math of trading. All right, so you don't have to win most of your trades. You don't got to win over 50% of your trades. Out of 10 trades, you don't got to win 7 of them. Out of 100 trades, you don't got to win 70 of them. It means if you incorporate discipline in your exits, see, discipline in your exit, it matters more than you being right on the direction of where it's going. And that is a mindset shift that most beginners are not ready for. I know y'all are, but I'm just saying. All right, but a lot of people too focused on trying to win every trade instead of building a system that actually works even when they lose. Y'all with me? Y'all, that makes sense, right? Now look at the bottom row. For me, this is the gold standard, the 1-to-3. Look at the 1-to-3. That 1-to-3 is the golden standard, ladies and gentlemen. I'm telling you, $1 risk, $3 targeted. I'm going to get in here, put the stop loss right below it. My profit target is going to be 3 times higher than my stop loss. And with this one, I only got to win 26% of the time. I can lose 74 trades out of 100 trades, nearly 3 out of every 4, and still walk away profitable. I really want that to sink in. I'm gonna shut the fuck up for a second because I really want you to sit with that for a second. This is not just a trading concept, okay? This is a life concept. This is what it means to protect your downside and let your upside run, okay? Every professional trader I have ever studied, every system that works long term operates somewhere in between the 1 to 2 and the 1 to 3 range or better. Not because they win all the time, but because when they win bigger than when they lose. And that type of asymmetrical balance, like that asymmetry, that imbalance actually in your favor is what separates people who survive the market from people who blow up their whole account. Anybody confused about what I am talking about, please let me know. And if not, can y'all do me a favor, tap the screen like who that is tapping the screen. Thank you. I appreciate you. Yeah, thank you. And share the live out, y'all. Come on, get live, get active with me, get active. Now, look at the picture on the right, the P&L calendar. For those that don't know, P&L stands for profit and loss. All right. Now, every green day that you see, right, is a day where money was made. Every red day is a day where money was lost. And I want you to look at this calendar with fresh eyes now that you understand what risk to reward mean. Because this calendar tells a story, and the story is really not what y'all think. It's not what most people think. When they see red on a trading calendar, they think it mean bad. All right. Look at let's look at March the 6th. Let's look at March the 6th. It was red, right? Negative $50.63. March 8th, red. Negative $91. March 14th, 15th, 16th. 3 red days in a row. Y'all see it? Negative 75, negative 90, negative 81. Then look at March 27th. Negative $130. March 28th, negative 92. Now, before somebody in the chat say, Coach, why are you showing us losing days? I want y'all to keep watching, right? Because here is what those red days paid for, right? March 9th, positive $1,500. March 10th, positive $3,200. March 17th, my bad, positive $2,500. March 29th, positive $4,500. March 30th, positive $2,800. Do y'all, anybody get what I'm saying? Anybody still confused? Do y'all see what happened? Now let's make this crystal clear. The losing days averaged somewhere between $50 and $130. But the winning days brought in $1,500, $2,500, $3,200, $4,500, $2,800. That is exactly what a healthy risk to reward ratio looks like in real life, ladies and gentlemen. We don't want to win every day, right? We don't even want to be close to winning every day. But when we win, right? Significantly bigger than when we lose. That is the game. Not picking perfect setups every single time. That's not the game. Having a green day every day is not the mission. The real game is making sure that when you take a win, is literally larger than your losses. And the only way you do that is by keeping your losses small, because you can't control how much money they're going to give you, but you can control how much you going to get them. Oh, you can control your losses. You ain't have to take that big ass loss. You never have to take a big loss. You never do. You can always get out of the trade when it is down just a little bit. You understand me? Hey, I'm talking to you. Do you understand me? Yes or no? Can you let me know if you understand me or not? Y'all, the engagement, I really need the engagement. So talk to me. Let me know if you get what I'm saying. Okay. That's all I need is at least one person, right? Now, I want to make sure that we know, like, this is only possible if we know our risk to reward ratio before we ever enter a trade. Not after, but before. Okay? Not after, before. Now, the psychological piece I want y'all to understand about what y'all looking at. Them red days on the 6th, the 8th, 14th, 15th, 16th, 27th, 28th, those are not failures. Those are the cost of doing business. Every business has expenses, ladies and gentlemen. It's the price of doing business. A restaurant buy food that goes bad, don't it? Don't they got to throw food away? Even clothing stores got shit that don't sell. Contractors buy wood and all dirt and shit that they don't even ever use. So literally, losses in trading these are our operating expenses. That's how we got to look at it. The question is not whether or not we're going to have them or not. The question is whether you can manage it. Have you managed them small enough, right? Can you make sure that your losses are small and that your wins can cover them and generate profit on top? Otherwise, you taking so big of a loss. You know how much winning it takes to cover up the losses you just did? Let's not do that to yourself. We're going to separate the disciplined traders from the gamblers. All you gamblers, I want y'all to call that hotline that's on FanDuel. Call that hotline that's on FanDuel. What up, Len? Thank you for the follow, Silky. I appreciate y'all for the engagement too. Thank y'all for whoever tapping the screen. Don't break a nail. I appreciate you so much. Thank you for the love. But yeah, we're going to separate them from the gamblers. See, the gambler hopes every trade works, but the disciplined trader knows the math works. It's all about math because they built this in a way before they ever clicked the buy button. We already know I'm getting in here. If it go here, I'm getting out. And if it go here, I'm getting out. And so I'm setting it up to where I'm taking profit right with the perfect risk to reward ratio. Because I'm only going to lose this much if I lose. I'm only going to lose this 1%. I done built it in. So you wanna keep that in mind, ladies and gentlemen. I want to make sure I share that with y'all because I ain't want to talk about nothing else tonight until we actually got that out of the way. Okay? Yeah, we had to get that out the way. Here we go. All right, how y'all doing? Now talk to me. Everybody, if that's all y'all wanted to know, that's it. I just had to make sure I started it out with that. But how y'all doing? Talk to me. What's good? What's goody? It's 1:50 a.m. April 9th. We already setting it all. We already doing good, y'all. We doing phenomenal. Now, usually around this time we wouldn't be doing so well. I'd be ready to lay down, but we doing phenomenal. This is where it also gets important. Everything I just showed y'all, the risk to reward concept, the calendar, that is the trading side of the equation. Okay, but I want y'all to understand that trading is real, the results are real, the strategy is real. But what I really want y'all to understand even more, before we go any deeper, trading is not really where you start at, okay? Trading is where you go after you have already built a solid financial foundation, ladies and gentlemen. And that foundation, the thing that protects you when the red days come, okay, the things that keep you in the game long enough for you to develop this skill that you just saw on that calendar or that you see other people on TikTok and on YouTube showing you, right? That foundation is investing. Investing is how you do this. Some of y'all, don't even realize you need to start trying to get hundreds of shares. Some of y'all need to get enough money to buy hundreds of shares. You've never sold a put, never sold a call. Okay? You've never traded futures. It's time for you to do something different so you can get different results. What up, Freebird 365? Or you could do the same thing different and get different results. All right. So literally, you need to have this foundation. Right now, we are going to shift into the main content. We're going to talk about why investing comes first and how compound interest works. You should not be confused about compound interest after this live stream. All right, and exactly how to invest the proper way. I don't think nobody's showing them how to do that. We're gonna break it down tonight. At Ironworth Trading, this is the standard. It's not just about trading setups. It's about building disciplined, financially complete people. That's what I'm on. And it starts with the foundation. So we're gonna get into it. All I need y'all to do is again hit the follow button, tap the screen, share the live out, show some love, y'all. I'm showing y'all love. I'm showing y'all love. This is how I show love right here. This is how I show love. All right. Let's see what we got. Yeah, here we go. Now, I wanted y'all to see that P&L calendar, so y'all can understand the risk to reward concept. That's what I was showing y'all there for, so you can see how it works in real trades with real numbers, like from an actual calendar, right? So that you can see like the losing days average 85 to 130, the winning days average 2600. That's just gonna help you. That's gonna help you understand. All right, so where we at? Where we at? I want y'all to look at those numbers on the screen. Let me show y'all these numbers real quick. These four numbers right here. Look at these four numbers. The first number is 3%. Right? Now, that is the average annual inflation rate in this country. 3%. This is the average annual inflation rate. Every year, shit gonna get more expensive. You best believe it. Every single year, the stuff that you need to buy, your groceries, your gas, your rent, your mortgage, your utilities, your clothes, everything costs 3% more than it did the year before. And the second number is 0.01%. Y'all see that? 0.01%. Y'all with me? Guess what this number means? This is what your average checking account or savings account pays you in interest. That's how much money you making on top of the money that you saving, right? You think you doing something by saving money? You're not doing shit by saving money. Excuse my French. I just got to be real with you. I don't know if they're not teaching us this in school. Our family members don't stress this enough. All right. This is what your average checking account or savings account pays you in interest. Not 3%, not the amount that is taken from you every year. Not even 1%, okay? 0%, 0.01%. So your money is losing 3% of its purchasing power every single year, while the bank pays you almost nothing to hold it. And then this third number right here, this 10%, pay attention, y'all. I'm telling you, this is where the money at. This is where the money at. This 10%, this is the historical average annual return of the S&P 500. For those that don't know, that's the index that tracks the 500 largest companies in America. I'm talking about going back decades. All right, 10%. And the fourth number right here, this is the most important too. $0. $0. That is what your money earns sitting still in a checkings account. For all the trap people and all the, old school folk, that's how much money your money earn in a shoebox. That's how much money your money earn in a couch. $0. It earns $0 in the wall. Your money earns $0 in a checking account. When you factor in what inflation is doing to it, 0. Okay, actually less than 0, because 3% is eating it alive, while 0.01% barely make a dent in it. You understand what I'm telling y'all? So these four numbers are the problem, and investing is the solution. Put a W in the chat if you get that. All I need to see is W's. I like to see winners. It stands for winner. Winner. All right, it means you got it. It just symbolizes that you get what I'm saying. All right, now the problem that a lot of people have, all right, this is what most people do, and I need y'all to be honest with yourself about whether this sound familiar or not. They see somebody on social media, right? Maybe somebody like me. We might be posting gains, we posting wins, talking about the market. They get all excited and shit, and they think this is the opportunity. They open a brokerage account, they put some money in it. They don't know what they doing. They buy something random, and then the market move against them. They lose money, and then they say the market rigged. Or they say trading don't work. Right? Rich people got all the advantages. I'm here to tell y'all the market not the problem. The approach is the problem, right? Because what they skipped, what almost everybody skipped, is step one. Step one is not learning to trade. Step one is learning to invest. Investing is what gives your money a job while you are still developing every other skill. You see what I'm saying? You can't skip investing. Investing is what protects you when your trades don't go the way that the shit should have planned. The way you planned it. It should have planned it. Right? Now, I showed y'all the P&L calendar earlier, you know, just so you can see that even experienced traders have red days. Ashley Love says been investing for 24 years. Congratulations. But yeah, the difference is between the traders that have red days or whatnot is having a foundation underneath so that the red days don't destroy you. Y'all feel me? Investing is that foundation. Without that, you building a mansion on sand. You building your house on sand. You just building on sand, right? We not gonna do that. And I want to say this so that it lock in with y'all. Y'all can write this down if you're watching on the screen. I want you to write this down. Put it in your notes or something if you're watching on your phone or whatever. So investing builds your wealth. Trading is a skill you add on top of that wealth. You do not need to trade to get rich, but you absolutely need to invest. I'll say it again because I need it to sit. You do not need to trade to get rich. Plenty of people became millions of dollars by doing nothing more than consistently investing in index funds every single month, never touching it. No charts, no options, no setups. I'm talking about just consistent investing over time. Now, do I teach trading? Absolutely. Is trading a powerful income tool when done correctly? Yes, indeed. Okay? But trading without an investment foundation, underneath that is like trying to build a skyscraper on a dirt road. Heavens no, we're not gonna do that. You need the concrete poured first. You gotta put the foundation. You gotta have a foundation set. Y'all know all my construction workers know how it go. And that's exactly what we're gonna do tonight. We're gonna set the foundation. All right. So the money standing still is literally the problem. The money standing still is the problem. So let me ask everybody in the chat a question real quick. Where is your money right now? I ain't talking about not your investment account. I'm talking about the money that you're not actively using. Think about it. The savings you've been building up, the tax return you got. Maybe you got a bonus from your job. Where is it sitting at? And if the honest answer is a checking account or a regular savings account, I need you to understand something. That money is losing value every single day. I'm not hypothetically speaking, okay? Not eventually. I'm talking about right now, today, right now, as this live stream is happening. Inflation does not stop. It does not take weekends off. It does not care that you work so hard to save that money. Every single year at 3% inflation, $100 becomes worth $97 in purchasing power. The year after that, it becomes worth $94. The year after that, about 91. So 30 years of inflation at 3% turns $100 of purchasing power into about $40, bro. This is not I'm not exaggerating. $40 from 100 just because you left it alone and didn't invest it. So this is why I'm in y'all ear tonight. That's why I'm in y'all ear. That's why I'm in y'all ear tonight. To make sure that y'all get it. You got to understand and overstand. I'm not here to sell you shit. Somebody called me today and was like, man, I'm thankful you don't try to sell shit. I don't try to sell. I do be trying to sell shit. They just don't buy it from me. Yeah, so I just give it out for free. I give out as much as I can for free. And just think about if I'm doing this shit for free, what I'll do if you support me, right? So fuck it. I ain't here to sell nobody nothing. I need them to get this. I'm not here to impress y'all with numbers. The clock is running on your money right now. The clock running on your money right now, and most people don't even know it. So look at the comparison on the screen. On the left side, look at this on the left side. We got 10,000 invested, right? $10,000 invested in the S&P 500 index fund at a 10% average annual return. Y'all see that? After 10 years, that 10 bands is worth about $25,937. You didn't work for that extra $15,000. You didn't trade for it. You didn't stress about it. You put $10,000 in, you left it alone, and compound interest did the rest. Okay? After and this is not to mention some of those years are going to give you more than that. Of course, you got downsides, but hey, it could be more than that. I'm just throwing that out there. But after 20 years, $67,000. After 30 years, $174,000 from $10,000. After 30 years. So you put in once and you never touch it again. Now look at the right side. We got 10 bands sitting in a checkings account at 0.01% that we was just talking about earlier, ladies and gentlemen. After 10 years, $10,010, you made $10. $10 in 10 years. After 30 years, $10,030. $30 in 30 years, while inflation destroyed the actual value of every dollar in that account. Y'all get me? So I need y'all to see this comparison right now so y'all can get in y'all head what it actually means. That's it. I'm going to move forward. The market ain't gambling when you invest in index funds over a long time horizon. But leaving your money in a checking account while inflation is eating at this shit like termites in a wooden house, like that's a real gamble. That's the risk that most people taking right now without even knowing it. They don't even realize they taking that loss. Donald Jeff says, I'm paying $5,000 to the first 5 persons who blocked the fuck out of me for coming in here with that bullshit. I'm just playing, y'all. Sorry, excuse my French. Excuse me for the profanity. He got to go. I hate when people come in here with that spam. So many. TikTok need to do something about these robots. All right. Now, what we're gonna shift our mindset. We're gonna shift our mindset. Let's see what we got. Stop thinking about money as something you spend. Start thinking about money as something you deploy. Every dollar you put into an investment is a soldier going to work for you 24 hours a day, no days off. Your money can work harder than you ever can, but only if you put it to work. You have to deploy it to employ it. That is the mindset shift that will separate where you are now from where you'll be in 10 years, okay? That's the mindset shift. The mindset shift I need every Iron Worth trader to make tonight. Stop thinking about money as something you spend. It's a soldier. It's going to work for you. That soldier worked 24 hours a day. When you sleep, your money should be working for you. 7 days a week, 365 days a year. It do not call out sick. It don't ask for a raise. It don't need a lunch break. It's going to work consistently, constantly, right? Over time, it produces more soldiers. That's the beauty of it. That your money creates money that creates money. That money that your money created is now creating more money for you too. Your returns generate more returns, and then those returns generate more returns. I want that for you. Don't you want that for you? I want that for you. I want your money to make money for you. Your money should be making money for you. You trading is not necessarily your money making money for you. I'm talking about compound interest. We are going to talk about this for a second. This is the mindset piece has to come first, though. If you still think about every extra dollar as money that you deciding whether to spend or save, you playing the wrong game. You playing this shit wrong. I'm telling you, the question is not spend or save. The question is always spend or invest, spend or deploy. And when people who build real wealth in this country are the people who do that, who make the most money, like the real money, are the ones who choose to deploy their money as aggressively as they can. You know what I'm saying? Really aggressive. As aggressive as possible. As early as possible. And they let the time do all the heavy lifting. I don't blame you, Tar Heel. I don't blame you. All right, we on compound interest. Warren Buffett called it, I think, it was Einstein. Albert Einstein said that compound interest is the eighth wonder of the world. Right? Drop in the TikTok chat, right? Drop in the chat right now, y'all. How much do y'all feel like y'all need to never have to work again? What is your financial independent number? How much do you need to never have to work again? I ain't talking about your retirement when you getting older and all that. I said, how much do you need to never have to work again? Put it in the chat. Have you thought about this number? Have you calculated this number based on your monthly expenses? Think about how much you need to never have to work again for the rest of your life. A lot of people I meet, they never thought about it. It ain't about how much you make either. Not how much you save, how much is actually working for you right now in the market is what you need to think about too. How much of your money that you got already? How much do you currently have invested? Not how much you make. How much is actually working for you right now in the market? So if the answer is 0, think about that. If it's under 500, think about that. You just getting started, right? If it's 5,000, you got a little foundation. And again, ain't no judgment. The only wrong thing that someone can do is to lie to themselves about this. So you can say, I'm gonna wait till the right time. That's the wrong thing to do, is to try to wait for the right time. And again, you can't fix what you are not willing to face, ladies and gentlemen. You can't do that. You can't do that. Now, this is important. I've been excited about this all night because this is the concept that once it clicks, and I mean it really clicks, not just intellectually, but emotionally, it's going to change everything about how you feel. It's going to change everything about how you make financial decisions. Compound interest, yes. Right? One of the greatest minds in history, in human history. Now, he reportedly called compound interest the eighth wonder of the world. He said those who understand it earn it, and those who don't pay it. Do you want to be someone who pays compound interest, or do you want to be someone who earns compound interest? I'm going to make sure y'all someone who earns it. Tonight, y'all going to overstand it. So not just the surface level, we're going to go all the way in. What is compound interest? What is it? Compound interest is when your money earns money. I'm going to say it again. Compound interest is when your money earns money, and then that new money earns money too. Anybody still confused? I'll walk through that slowly because the simplicity of it hides how powerful it actually is. See, you start with $100, right? You earn 10% interest. Now you have $110. But the next year, you earn 10% again, but not on the original 100. You earn it on the 110. So now you have $121. The year after that, 10% on $121 gives you $133, right? And 10 cents. You see what's happening? The interest is being added to the principal, and then the interest earns interest on top of itself. This is stacking. This is what they say when I'm stacking money. This shit stacking. That's really what's stacking. It compounds. And in the beginning, I'm gonna tell you like this, right? This how they do it. This how they do it in the trap. They go and get. It's gonna sound crazy. They go and get and don't say they getting it fronted to them, and so they using leverage. This is using leverage, but they'll go and get it fronted or whatnot, and so they leveraged it. This is almost like being in a prop firm account down there. But anyways, they sell it. They make their money back off of it, the ROI. They take it and reinvest it all, and then they sell it again and reinvest it all. And this is compound interest on the street level. So they do it already. A lot of people already do compound interest. They don't even realize that they're doing it. This is how you're supposed to do it, though, okay? Now, in the beginning, the growth looks slow. It's almost it's boring. But over a long enough period of time, it accelerates into something that looks almost impossible to believe. The math is undefeated. I'm telling you, it has been working for wealthy people for centuries. I just gave y'all that trap definition because I come from the projects. All right. I come from the projects. I saw people, do this inside of those. I come from I was born in 91 during the crack epidemic. Now, don't act like y'all don't know what's going on. So I seen what they was doing, but I didn't realize that these were, damn near entrepreneurs and investors. You're investing in the pack when you do that. But wealthy people do it too. Wealthy people do it too. This has been working for them for centuries. And most people was never taught how to access compound interest. So I want y'all to look at this formula. Look at this formula that I got right there. Y'all see it? Right here in this box. Look at this formula. A equals P times the quantity of 1 plus R divided by N raised to the power of N times T. I'm going to translate every single piece of that into plain English so nobody is confused. A is your final amount, the number that you want to end up at. Okay. P is your principal, the money you start with right now, today. R is your annual interest rate expressed as a decimal. So if you earning 10% per year, R is 0.10. N is how many times per year your interest compounds. If it compounds monthly, which is how most brokerage accounts and index funds work, all right, N equals 12. And T is time. I'm talking about in years too. So I want you to notice something about this formula. There is no variable for how smart you are. There is no variable for how smart you are. There is no variable for what school you went to, what neighborhood you grew up in, what your credit score is. The most important variable in the entire formula, the one that got more impact on your final number than any other one, is time, ladies and gentlemen. T, time. The longer you leave your money invested, the more violent the compounding gets in your favor. This is why Roth accounts do so well. Independent retirement accounts do well because your money gets to grow tax-free. And it gets to grow. You get to see the compounding work for you. You get to stay in it long enough to see the compounding work in your favor. The only way to maximize T, aka time, is to start as early as possible, which means today. Today is better than tomorrow. Tomorrow better than next week. All right. So again, we're gonna go to the next one. You invest $5,000 in the S&P 500, right? Look at this bar chart right up under it as well. So I'm gonna walk y'all through what happens to that $5,000 at a 10% annual return when you never add another dime to it. Again, this is for educational purposes only. So at year 0, $5,000. At year 5, $8,000, $8,047, right? So you've been doing nothing and you already made over $3,000. At year 10, $12,968 from 5K. You almost tripled your money without lifting a finger. And at year 15, $20,820. Sorry, I said that wrong. $20,886. Yeah. At year 20, $33,637. At year 25, $54,174. And at year 30, $87,247 from $5,000 that you put in once and you never touched it again. You put in 5K, you ended up with 87K. You did not work for that $87,000 of growth, but your money did. And that is just $5,000. That's $5,000 going in one time with no additional contributions. That's not a person that's maxing out they shit every year. I'm talking about 5K going in one time. This ain't a person that's putting in 5K again and again and again and again. Oh yeah, they're gonna be straight. Imagine if you added a 100 or 200 on top of that every single month. On top of that, see what I'm saying? This is exactly what the calculator on this screen that I'm showing y'all is designed to show you. Tar Heel says, earns it while I'm sleeping. That's right. That's right. A beautiful woman named Sasha Sazetsky taught me about the rule of 72. I'm thankful for that. She works with Primerica. If y'all need life insurance, inbox me. All right. If you need life insurance, I got you. Inbox me your name and your number and the best time to call you. That is what taught me the rule of 72 when I went and got my license to sell life insurance last year. And I started learning financial literacy at an alarming rate. I already was doing well. That's why she recruited me, right? But I learned a lot of things. I'm still learning. But I learned the rule of 72. I think y'all will like this. They call it the banker's rule. This is one of the simplest and most useful mental math tools in all of personal finance. And I want every one of y'all to have it memorized, right? That way you know how it works. So you take the number 72 and you divide it by your annual return rate. Okay? That's the rule of 72. You take the number 72 and you divide it by your annual return rate. The result is going to tell you approximately how many years it takes to double your money. You want to know how long it's going to take for you to double your money? The rule of 72 got you. That's it. So at 10% annual return, 72 divided by 10 equals 7.2. Your money doubles every 7.2 years. At 8%, 72 divided by 8 equals 9. Your money doubles every 9 years. At 6%, 72 divided by 6 equals 12. Your money gonna double every 12 years. So this is why this matters practically. If you are 30 years old right now and you invest $10,000 at 10% annual returns, by the age 37, you're gonna have 20,000. By age 44, you're gonna have 40,000. By age 51, you're going to have 80,000. And by age 58, you're going to have 160,000. By age 65, you'll have 320,000 from one lump sum of $10,000 that you invested at 30 and never touched it again. That is the rule of 72 in action over a lifetime. And when you add monthly contributions on top of that, that's when the numbers start to get staggering. Okay? But there's something called the cost of waiting. There is a cost of waiting. I need that to be the most dangerous thing I talk about. Like a lot of young people, they get it fucked up. I hear it all the time. I'm going to start investing when I got more money. I'll start next year when shit calm down. I'm too young to worry about that right now. Let me show you exactly what that cost you, okay? So we got two people, same age, both of them making the same amount of money. Same everything. They driving the same car, all that. But the first person start investing $200 a month at age 25. The second person decide to wait until they age 35, right? So the same $200 a month. They both start, they put in the same amount. Same 10% average annual return. That means they making 10% back on the returns every year. So after 30 years of investing, the first person that started earlier, they got about $452,000 at age 55. But the second person who waited just 10 years more, they got $152,000 at the same age. That is a $300,000 difference from the same $100 monthly investment. The second person didn't invest less money per month. They just started 10 years later. But them 10 years, those 10 years of compounding that person B missed out on cannot be recovered. You cannot buy time. So you taking your sweet ass time with investing, and I don't know why. This live stream was designed to wake you the fuck up. That was me beating the mic up like it was your forehead, y'all. This was designed to wake you up. You can't buy more time. So the only move is to start. The time is start now, not later, not eventually, not when things feel more stable. Now, okay? Now, you got to get that. Let me see where we at now. I'll talk how to invest the proper way. Yeah. All right. Pay close attention, y'all. Pay close attention. All right, we talked about a lot tonight. Inflation, compound interest, the cost of waiting, all of that. You know what I'm saying? We talked about that was the why. All of that was the why. This part right here, this is the how. All right, this is the how. So I want to make sure we all make sense. So first thing we're gonna talk about is the emergency fund. Crazy man, crazy woman, the emergency fund. I want to be very clear that this is step 1 and not step 2, not step 3. This is the proper way to invest. Step 1 is building your emergency fund before you invest a single dollar in the stock market, ladies and gentlemen. This is why I'm telling you this is non-negotiable. My first year trading, investing, really my first year investing too, because it happened to be trading as well. I've had to close positions I didn't want to close because I didn't have this part. Okay, I had to sell stocks I didn't want to sell because of emergencies. When life happens, you don't want to get out of a position because you didn't have a freaking emergency fund, right? This is non-negotiable. The stock market goes up and down. This is not a flaw, and that is how it works. That's how it works historically. Even though the market always recovers, there are periods where it drops 20%, 30%, even 50% before it ever come back up. Now, if you got all your savings invested into in the stock market and life throws something at you, right? I'm talking about your car could break down. You might lose your job, let alone a family member, a medical bill will show up, whatever the case may be. What do you have to do in that case? You're going to end up selling your damn investments. And if the market is down, when that happens, you locking in a loss. You are now turning an unrealized loss into a realized loss. You are selling at the worst possible moment, and that loss is permanent. All you have to do is just make sure you had an emergency fund account. So you do not get to participate in the recovery, but your emergency fund is the thing that will prevent that from ever happening, y'all. I'm telling you. It's cushion. It's more cushion for the pushing. All right. It's the buffer between your investments and real life. 3 months of your living expenses is the absolute minimum that you need for an emergency account. 3 months. You just need about 3 months of your living expenses. That's it. Saved up in that emergency account. 6 months is what I personally recommend, and I'm very specific about where this shit live at too. It shouldn't just be in a regular checking account. Again, this is for educational purposes only because they should have taught us this shit in school. It should not be in a savings account paying you nothing, but in a high yield savings account. Banks, you got a few banks that do that. They're currently paying between 4 to 5% annual interest on savings accounts. Now that's a real return on your safety net while they just sit there waiting. Calculate your monthly expenses, add up your rent, all the shit that you put out to survive, and multiply that by 3. That is your target. That's how much you need to have in there. So fund that account first. Do not invest in the market until that number is met, ladies and gentlemen. This is not optional. This is the foundation of the foundation. Ain't nobody gonna tell you that. I'm gonna let you know. Everybody else, if they tell you anything less, they just trying to take your money. They don't give no fuck about you. Now we're going to talk about accounts. I also want y'all to get this too. An investment account is a container. The container is what holds your investments inside of it. And depending on which container you choose, the government either tax your growth significantly or barely touches it at all. Okay. Rich people make sure that they shit barely gets touched at all. That's the difference. The tax treatment is worth tens of thousands, sometimes hundreds of thousands of dollars over the course of your investing lifetime. So choosing the right containers in the right order matters enormously. Now, there's 3 accounts every single Ironworth trader needs to know. I'm going to walk y'all through them. The first account, priority number 1. I know y'all heard about, I know some of y'all already got a 401k, but a retirement account. That's important. The future you, I know you're not saying fuck the future version of you, so the current version of you can enjoy whatever the hell going on right now. Some of y'all got the 401k, but only if your employer offers a match, then that's cool. Now, what I'm telling you on that part, that's critical. If your company matches your 401k contributions, let's say they match 50% of what you put in, like up to 6% of your salary, that match is a guaranteed 50% return on your money before the stock market does anything to it. There is no investment on earth, no trading strategy that I can give you. Ain't no asset class that's going to give you an instant guaranteed 50% return the same day you put the money in. So I think that's pretty cool, but I don't think it was designed to actually help you. So again, a Roth account. It might be the single most powerful wealth building vehicle available to everyday people, regular everyday people in the entire country. And a lot of people still don't have one and they still don't use it. All right. But this is how it works. You put the money in, you contribute money that you have already paid taxes on. I repeat, you already paid taxes on this shit. Your money goes in, and from that point forward, it grows. It grows completely, like 100% tax free. So when you retire and you start pulling the money out, you pay zero taxes on your withdrawals. I'm talking about none. All of that money that you made, all those decades of compound interest, all that growth, the government does not touch it. All right. And yeah, in 2024, you can contribute up to $7,000 per year in a Roth account. And I think you can open one for free if I ain't mistaken. Yeah, completely free. Fidelity, Vanguard, Charles Schwab. Take about 10 minutes online. And you can start with as little as $1. All right. If you do not have a Roth IRA right now, I need you to commit before this live stream ends. Inbox me your name and your number only if you are serious about opening one. All right. Not next month, not next week. Every month that you wait is a month of tax-free compound growth that you do not get to get back. All right. Now, another account that I think is a priority is a regular brokerage account. You got your emergency, you got your Roth, right? Your Roth, you maxing that out every year. You putting $7,000 in there. That's where you're gonna continue investing beyond the annual limit. But when you do this, you don't have no annual contribution when you got your own investment account. When you can withdraw, no restrictions on when you can withdraw. Just you're gonna pay capital gain taxes though on your profits when you sell. But this account is going to allow you to invest as much as you want. And you'll be able to access your money whenever you need it. It ain't like the Roth to where a Roth is like a safe. All right. You don't want to take that money out until you can in the future. Ooh, excuse me, y'all. I hope I don't give y'all the yawns. I'm sitting here yawning and shit. I think it might be time for me to roll out. So this is eventually, when you're doing that, this is eventually where your trading account is going to live at. In that investing account. This is where you're going to get the trade options and shit. This is completely separate from your retirement account, which you never touch for speculative positions. Don't do that. So we got a lot of platforms that offer free brokerage accounts with no commissions, and you could be up and running in a day. It don't take no time. All right. Now, a lot of people ask me, so, all right, coach, but what do I actually put my money into? Like, I got my accounts open. Now, what do I do with my money? I'm going to tell you this way. All right, I'm going to tell you the thing that a lot of people in the financial industry really don't say, because making it simple doesn't make them money, right? Simplicity does not make them money. So for a beginner investor, honestly, the most intermediate investors, the answer is index funds. ETFs. ETF is an exchange traded fund. It tracks broad market indexes. All right. Basically, an ETF is a single investment that holds hundreds, sometimes even thousands of individual stocks. It is a basket of stocks. It's a folder of stocks, an ETF. When you buy one share of an ETF, you are instantly diversified across a lot of companies. All right. Now, diversification just means, when I say diversified or diversification, that just means that your money is spread across a lot of different companies in a lot of different sectors. So if one company fuck up and fail, it does not destroy your money. It does not destroy your portfolio. You own just a tiny piece of everything. This is the purpose of an ETF. So the most important ETF for a beginner is VOO. VOO. This is Vanguard's S&P 500 ETF. It tracks the 500 largest publicly traded companies in America. I like SPY. I like the SPY. But yeah, Apple, Microsoft, Amazon, Google, Nvidia, Tesla, all of them inside of one fund. And the average return of this index is approximately 10% per year going back decades. And guess how much they charge you to manage this? 0.03%. That means for every $10,000 you invest, Vanguard charges you $3 per year. $3. That is not a typo. Yes, it do say $3. $3 per share on every $10,000 invested. All right. That's a big deal. And it's available to every single person watching this live stream tonight. Now, the second ETF worth knowing is the VTI, Vanguard's Total Stock Market ETF. For me, I like QQQ. All right. Somebody says opportunity cost. Yeah. But VTI tracks over 3,600 companies. It includes large companies, mid-sized companies, smaller companies, all in one fund. Even more diversified. All right, same type of returns every year. If you want to own the entire U.S. stock market with one purchase, VTI is the fund. Now, the third ETF I want to talk about is SCHD. This is the Schwab U.S. Dividend Equity ETF. This one works a little different, see, because SCHD, they focus on companies that pay consistent and growing dividends. And for those that don't know, a dividend is a cash payment that the company sends to the shareholders. You basically getting paid because you own this stock and they making extra money, so they breaking bread. And they usually do this quarterly. They do this just because you own the stock. So when you hold SCHD, you receive actual cash payments deposited directly into your account every 3 months. And when you reinvest those dividends, which we'll talk about in another live stream, the drip, maybe I'll talk about it tonight, but you build a self-reinforcing income engine that accelerates your compounding significantly over time. Do you understand? Do you understand? TC, are you with me? Oh yeah, we got the dollar cost averaging though. We're gonna talk about dollar cost averaging. This strategy right here holds all of this together. This is dollar cost averaging. I want to explain this thoroughly, but I'm getting very drowsy. But this is the thing that prevents emotion from destroying your investment results. See, dollar cost averaging means you invest a certain amount, a fixed amount, where you're going to put a certain amount of money and you're going to invest it on a fixed schedule every single month, regardless of what the market is doing. And if the market is up, you invest. If the market is down, you invest. If the news is terrible, you invest. If everybody on social media, everybody on the internet panicking and shit, you invest. You do the same amount, the same date every month. And this is why this works powerfully. This works so well. Hold on, let me do this puzzle on TikTok. They bothered. But yeah, when the market is down, your fixed monthly contribution buys you more shares at lower prices. So when the market go down, the money that you set up to automatically buy is going to let you buy more shares at lower prices. And when the market is up, it's going to buy fewer shares at higher prices. And over time, your average cost per share ends up lower than the average price of the market during that period. I know it sounds a little complicated, but it's really not, y'all. You automatically bought more when things were cheaper. You removed the guessing. You removed the emotional decision when you dollar cost average. You ain't got to worry about trying to guess, is this a good time to buy or not? I know that the research is overwhelming on this. Okay, most investors who try to time the market They think they waiting for the perfect moment to invest. These people underperform compared to the investors who simply invest the same amount every single month and never try to time anything. Your job is not to predict the market. Your job is to participate in it consistently. Automate it and leave it alone. Automate it and leave it alone. This is the final piece of the proper investing process. This is automation. I want to be direct about why this matters too. The biggest enemy of being a long-term investor or any long-term investment, right? Returns is the investor themselves. It is you. It's you. It's me. Every human being naturally emotional response to seeing their accounts drop 20% and feeling the urge to do something about it. Like you get that feeling you want to sell when shit start looking bad, and you want to buy when stuff start looking good. And that's the exact opposite of what produces wealth, all right? The investor who consistently beats the average are almost always the ones who set their investments up and they barely look at them for decades. Them is the ones who come out on top. There was a famous internal study done at a major brokerage firm, and they found that their best performing accounts was ones belonging to people who had either forgotten that they had the account or had died. Ain't that something? Time did everything for them. Those accounts just kept compounding with zero interference from human emotion. Now, I'm not telling you to forget about your money, y'all. That ain't what I'm saying at all. Don't get me confused. I'm telling you to build a system that runs without you having to make emotional decisions every month. You want to set up automatic contributions. You're going to turn on the dividend reinvestment program, the DRIP. Inbox me if you don't know how to do any of that. We got to start you from ground zero. You need to take this course. We got a course coming up in Chicago, and if y'all can make it there, inbox me. I'll get the dates to you. All right, but yeah, I'm going to be teaching people from a ground zero point. And if you can't make it there, inbox me. I do 1v1s. I'll come to you. I'll get on the phone with you if I can't come to you. Either way, God, I'll help you. All right, I will help you. We got to turn on the DRIP, the dividend reinvestment. So every dividend payment automatically buys more shares without you having to do anything. And then commit to it. Don't touch it. Commit to not touching it. How about that? Commit to not panic selling every time the market drop, right? Because SPY, the S&P 500, has recovered from every single crash that has ever happened, every correction, every recession. Every time there has been a panic in the entire history, every single one, y'all, the investors who stayed in, who kept buying, and they left, and then they just left it alone, those are the ones who captured all of that recovery. The ones who sold in fear, those are the ones who locked in the losses and they missed everything. They missed it all. Yeah, I got to know the difference between trading and investing. I know this shit sounds simple, but yeah, we just spent a couple hours building the case for investing, and we talked about why investing is necessary, how compound interest works, where to put your money, what to buy, how to automate it. And now I'm going to address the question that I know is living in the back of some people's mind, right? Coach, what about trading? You just said all this shit. What about trading? Ain't that faster? Can't I just trade and skip all this shit? Like, can't I just, like, okay. The answer is, yeah, you could try. But I'm going to show you exactly what that looked like, right? And why the order of operations matter more than anybody going to ever tell you. Investing is buying an asset. If you invest in a company, you bought that stock, you a part shareholder of it. You buy a stock, an ETF, a fund. You did this with the expectation that it was going to grow in value over a long period of time, years, decades. You are not trying to make money next Tuesday. You building a financial future that is measurably better in 10, 20, and 30 years. So trading is buying and selling assets over much shorter time frames, like days, hours, sometimes minutes. You got people that be in a trade for minutes. Everybody that trade futures, they be in that trade for less than 5 minutes sometimes. But nonetheless, people do this with the goal of capturing the profit from those short-term movements. See, trading requires technical analysis, which means reading charts. It requires risk management, which means you need to know exactly how much you're willing to lose before you enter into any position. You got to have emotional discipline, which means your plan, even when you going to make a plan, even when you fear and everybody else is greedy as hell and they telling you to do something different, you're going to make a plan. All right. And this requires consistent practice over time. You develop a reliable edge. Neither investing nor trading is wrong. I'm not telling you either one is wrong, but I'm just saying they are fundamentally different types of activities with different skill requirements. All right. And confusing one of them is the most expensive mistakes that you can make as a beginner. Right. All right, y'all. I do have more, but guess what? Might have to say that for part 2 because I am about to crash. Yeah, I'm about to crash. Y'all got the gist of it. Inbox me your name and your number if you're interested. I'm serious, and the best time to call. Don't procrastinate. Y'all enjoy the rest of y'all night. I'm gonna get up out of here before I turn into Rip Van Winkle.